Imagine owning a piece of a company that saw 10% of its value wiped out in January, only to turn around and pull off a record-shattering $450 billion gain in a single day. Would you call it the comeback of the year? Because on July 30th, 2026, that is exactly what happened to Microsoft. In just one afternoon, Microsoft created more wealth out of thin air than the entire company brought in from actual sales over the whole year. Same company, same baseline number, completely opposite reaction. Now, most financial headlines will tell you this was just AI hype or cloud acceleration. But if you actually open up the report, that's not what happened. It came down to one single word buried inside the fine print. A word almost nobody is talking about out loud. So why did Microsoft gain $450 billion in a day? If you've read one headline, you already have an answer. Azure. Microsoft's cloud grew 43%. Not held steady, accelerated, up from 40. And it crossed $100 billion in annual revenue for the first time. Those are real numbers. Any company would kill for them. But here's what bothered me. If Azure was the reason, why did Microsoft spend so much of that call talking about something else? Behind the headlines, behind every chart CNBC put on screen, was a line item with the most boring name in finance. Most investors skipped it. Wall Street didn't. Its value? $678 billion. Don't worry what it's called. Not yet. Just hold on to the number. Because 6 months earlier, Microsoft showed us almost the same one, and it went very badly. January. Microsoft reports a strong quarter. Revenue beat, profit beat, and then a number that should have thrilled everyone. The order book, $625 billion. A record, up more than 100% in a year. Nearly double. The stock fell 10%. Hundreds of billions in market value. Gone. Overnight. So how do investors look at a record order book and decide the company is worth less? This is where most investing advice quietly falls apart. Because markets don't reward big numbers. They reward certainty. And Microsoft had just accidentally given investors a reason to doubt what those $625 billion actually meant. Not because the demand was fake, because of who it came from. 45% of that backlog was tied to one customer, OpenAI, which had just signed a $250 billion cloud commitment. Wall Street didn't see demand. It saw a very large bet on one company's ability to pay its bills. And that question, can OpenAI actually pay, held the stock down for the next 6 months. Down 18% on the year. Near a one-year low, the safest large cap in America, and half of Wall Street had a one-word explanation: bubble. Every quarter, Microsoft spent more on data centers, chips, land, power, concrete, and every quarter the same question got a little louder: what if nobody shows up? That's the real fear. Not that AI doesn't work, that it works, and nobody will pay what it costs to run. So what changed in July? Microsoft didn't stop spending, it spent more. $41 billion in a single quarter, the biggest build-out in company history. If Wall Street was scared of spending in January, that should have made it worse. Instead, Microsoft answered the question that had been hanging over it for 6 months. The order book had reached $678 billion, up 84%. $51 billion of it added in the last 3 months alone. And Microsoft said every dollar of that increase came from customers who are not frontier AI labs. Enterprises, governments, hospitals, banks, companies buying AI because it solved a problem, not because they were building the next ChatGPT. The order book wasn't just bigger, it was broader. And now I can tell you what this thing is actually called. Remaining performance obligation. The dullest phrase in finance, attached to the most important fact in the report. In English, contracts customers have already signed and committed to pay for that Microsoft hasn't delivered yet. Not a forecast, not a projection, an order book. $678 billion of work already sold. Now put that next to Microsoft's revenue for the entire year. Windows, Office, Xbox, Azure, all of it. $331 billion. The order book is more than twice the company. Revenue is a report card. It tells you what already happened. The order book is the future, already under contract, which gives you the rule, the most useful sentence in this video. The market does not price the size of the order book. It prices who's in it. And the proof this isn't really a Microsoft story happened one day earlier. Meta, also building data centers, also spending enormous money, $31 billion in a quarter, also telling investors it would spend more. Meta fell about 9%, over $100 billion, gone. Same week, same industry, same bet, opposite outcome. And it wasn't the spending. Meta generated $31.9 billion in operating cash flow and spent $31.1 of it on infrastructure. Do that subtraction. Free cash flow, $784 million, which sounds like a lot until you remember it's what's left of $32 billion, down 91%. Here's the part that should stop you. Microsoft's cash flow fell too, and Microsoft spent more, $41 billion in the quarter, with $175 billion guided for the year ahead. Microsoft spent more and had the biggest day in market history. Because Microsoft showed investors the receipt, Meta showed them the bill. Spending isn't what gets punished. Spending with nothing to point at is. So how do you use this? Next time a company you own reports and the headline is about spending, ask 3 questions. 1. Is the growth accelerating or just continuing? Azure didn't hold at 40%. It went to 43%. Acceleration while spending is a signal. Deceleration while spending is a warning. 2. Is there an order book, and is it growing faster than revenue? Microsoft's revenue grew 18%. Its order book grew 84%. When those two numbers separate that far, the gap is the story. 3. And almost nobody asks this one. Who is the order book from? Because concentration is risk wearing a party hat. Which brings me to the part most videos about this will skip. That 45% didn't go anywhere. In January, Microsoft told us OpenAI was nearly half the order book. In July, it didn't update that number. It told us where the new money came from, which is a different question. Strip OpenAI out, and the backlog grew 25%, down from 28%. So read it carefully. Demand is broadening at the edges. The base is still concentrated. That's not a scandal, but it is a real dependency. Free cash flow is down. Margins are guided lower. A backlog is a promise, not a payment. So, back to the question. How does a company get $450 billion more valuable in 8 hours? Not because it suddenly became great. It already was. Not because investors discovered AI. They knew. Not because it was spending billions. That wasn't new either. What changed was uncertainty. Picture 2 identical used cars. Same year, same mileage, same price. One comes with a complete service history. The other comes with nothing. Which one do you feel better about buying? The car didn't change. Your confidence did. And remember what this record day happened to. Not a stock that was winning, a stock down 18% that half of Wall Street had spent months calling a bubble. So I don't think Wall Street paid $450 billion for good news. I think it paid for doubt disappearing. Because that's what a market is. A machine for pricing uncertainty. And when a company finally answers the exact question everyone was afraid to ask, the uncertainty doesn't shrink. It collapses in 8 hours. One last thing, because you might think none of this touches you. 58% of American families own stock. Only 21% own it directly. Almost everyone else owns it through a fund, inside a retirement account they set up once and never looked at again. They never picked the companies, the fund did. Microsoft is one of the 3 biggest companies in the S&P 500, and the top 10 are now roughly 40% of the entire index, a record. For the 25 years before this, it averaged 18 to 23. So when someone says they own the whole market, they own 500 companies, and 10 of them are half the outcome. That's not a portfolio. That's a bet with extra steps. If you have a retirement account with an index fund in it, you made money that day because of one company's order book, a company you never chose. And that $41 billion a quarter, that's concrete. Steel, electricians, power. Someone pays for that electricity. The biggest grid operator in the country put $6.3 billion of higher costs down to data center demand. That lands on household bills in 13 states. So you're in this trade 3 ways. Your retirement account owns it, your job market is being reshaped by it, and your power bill is helping build it. You never placed that bet. It was placed for you. And obviously, still a guy with a cartoon dog, still not your financial advisor. But now you know where to look. Everyone else reads the revenue line. You read the order book. Because the future rarely hides in the headlines. It usually hides in the footnotes. I'll see you in the next investigation.